Perfect. All right, so let's talk dividends and capital gains. All right, so at the end of the day, what we're trying to do here is we're trying to set the tone when it comes to the journey of investing, right? We're trying to really understand why investing is important and how these companies are set up to help us along the way, so we don't have to work as hard to make our money grow for us. So we're going to be diving into dividends, and with that also being capital gains and what that means for your money and how you should be approaching kind of protecting your wealth and building it going forward. So, disclaimer, I am not a financial advisor, accountant, or fiduciary. This is content that is supposed to be used and must be used for information and educational purposes only. You should make investment in financial decisions based off your own analysis while considering your own personal circumstances and risk tolerance. All that means is do your own research, all right? This may sound like financial advice, it may look like financial advice, but it's not, okay? This is just to keep you more informed and give you a little bit more perspective on how we can build wealth in other ways other than some of the ways you might have heard about, okay? So I do believe Mike is on the call. He is an accountant, so if we have some tax-specific questions that I can't answer with certainty, we might have to default to him, okay? So a little bit about me for those who don't know me specifically or who haven't been on these previous calls. I think I need to start introducing myself because it is important to understand where I'm coming from when it comes to investing. I am a long-term mindseted investor. I look at the market as a place to build wealth over time. Time is my friend. I look at time as a way I can reduce my own risk and kind of allow myself to utilize my time in other ways that I like to do. And some of the ways I like to utilize my time is I'm an entrepreneur, I'm a business owner. I like to educate myself in ways that is structured, but is also gives me room to be flexible and able to maneuver how I want to, right? So I've been investing in the stock market as a long-term investor since 2013. So, but the mindset has always been long-term asset building and really trying to, build communities and make them sustainable over time. So before we dive into dividends specifically and dividend strategies specifically, 3 questions we want to ask ourselves before investing in any stock, right? So this is any type of stock that is going to, at the end of the day, be a stepping stone to us getting to that position where we no longer have to work and trade our time for money, because we're all skilled people, we're all creative people. We don't need to be at the cubicle, at the desk, wherever it is that isn't where we want to be for more than, however many hours a week that you're working, right? So 3 questions you need to ask yourself before you start investing is this company within my circle of competence? Does it fit my risk and investment profile? And linking that to dividends specifically, is this a company that is going to help me build wealth? Is it a company that's going to help me beat inflation? Is it a company that is going to help me in 20 years build income and keep the same income or more income coming in when I don't want to work as much, right? And have I done the research necessary to make informed decisions about the stock and or the company, the direction of the company, right? So with that being said, let's start off with this quote, right? Someone's sitting in the shade today because someone planted a tree a long time ago. Warren Buffett. We all know Warren Buffett by name. If you don't know Warren Buffett, then definitely read up on him. I'm a huge Warren Buffett fan, but obviously what we have to do when it comes to people who have come before us is take what they've done, learn from it, and then adjust, right? So one thing that we can learn from Warren that is timeless is that what we're doing now isn't for us, right? What we're doing now is we're trying to build a legacy so the people who come after us don't have to work as hard, right? And I say that not with they can be lazy, right? Because we're not lazy people. We always have a growth mindset. We're going to give them an opportunity to have a head start, right? They don't have to look around and see what other people are doing because they know that their auntie, their great grandfather, their mother, their uncle, whoever it was who left them some shares, who left them some money, did what they had to do, sacrifice along the way to make sure that they could sit under the shade, right? So let's talk about dividends, right? Let's define what dividends are, what they mean, and how companies are setting you up for success by just holding their shares, by just believing in the company enough to put your hard-earned money to work in them, right? So what is a dividend? It's basically a reward, right? You hold my stock, I promise to pay you out at a quarterly, monthly, annually basis, a certain amount of that stock, because I want to thank you so much. I believe that the backbone of my company is my investors, so I want to take care of you, right? That's what a dividend means. Dividends are not something that is mandatory, right? Companies choose to do that, so that's something to keep in mind going forward. Only a select few companies do pay, right? And only a select few companies pay consistently. So when we're talking about income investing and investing for income, we want to not just look at, man, this company's paying me so much. Now we want to look at their growth prospects, right? Can they consistently pay me this amount, right? Have they increased their dividend over time? Like, what is their ratios looking like? Those are the types of things that we want to look at. And the first things that tell us whether or not a dividend is going to be working out is whether a company is well established or if it's not, right? You don't really want a company that's brand new, that's just IPO'd, to be given out a dividend, unless it's a specifically made for that purpose, right? You want that company reinvesting in the company. You want that company growing exponentially, right? When we talk about dividends, we also need to not neglect the share price when the dividends are either announced or paid out, right? So when it comes to companies that pay out dividends, that money is money that they're taking from their cash flow, that from their profit, and it's being paid out to shareholders. And that's money that's never seen again, right? So that's money that needs to be recorded, right? And as an investor, you need to understand that money is leaving, how that money is leaving the company, right? So it's not abnormal to see that when a company announces that a dividend is happening, that the share price the next day or two rises up a little bit to whatever that dividend was, right? It only makes sense, right? Because investors realize, wow, the company we need to regain this money that is about to be lost in a few months when the company pays out. So let's increase the share price now. And when the company pays it out, let's sell a little bit of our profit so we can kind of coincide with that share price movement, right? So when you're seeing those price jumps, or if you're trying to see if a company's worth buying before they pay out their dividend or after, you really want to pay attention to those price jumps. And we can go into that a little bit later when we look at a few different companies. So Antonio, how do we find these specific companies that pay dividends, right? There's a gajillion, and I say that facetiously, but there are a multitude of different companies that do pay dividends. But when we're talking about building an account that is built to last, right? That is built to really pay us over time and beat inflation. We know the Fed right now is pretty much propping the stock market up, right? And maybe not as much as it was at the beginning of the pandemic, but we know the Fed is propping the stock market up right now with printing money, with buying up the bonds, with buying up their own treasury bonds. So like you got to understand from the macro level, things are not okay, right? So we really have to understand which companies, whether it's a bear market, a bull market, whether it's high inflation, low inflation, interest rates are high, interest rates are low. We need companies that are going to be paying us over time, regardless of what's happening, right? So where do we find those companies? First, we look growth versus value, right? There are a multitude of companies that will pay out dividends based off whether they're focused on growth majority or their shareholders majority. Doesn't mean that they don't care about either or. It's just where's the focus, right? So that's where you want to begin your search when it comes to a dividend paying company, right? Your larger, more established companies that have been around for years, right? That have predictable income, that income that isn't going to grow exponentially year over year, right? It's not going to increase 10, 20, 30% over year. Like that's not going to happen anymore. So your Johnson & Johnsons, your Walmarts, your, what's another company that's well established, like your Caterpillars, like those companies now that have been around for years and years and years, that you know what their revenue is going to look like, right? So those are companies that pay out good dividends, right? But they also are companies that are going to grow those dividends consistently over time, but you're not going to really see too much of a price jump as you hold that share, right? On the flip side, a company like an Apple, like a Microsoft, a Qualcomm, an NVIDIA, companies that are focused on growth specifically, but do pay a little bit of a dividend because they're just rolling in cash and they need some way to pay out that money, right? Those are the types of companies that you can kind of mix into a dividend paying portfolio to add some growth, right? So your money is still growing exponentially. And again, you can tell the difference between a growth and a value company by revenue, right? Or look at their charts, right? We'll look at a couple charts later just to see, how the price is moving. If a company is too pricey in terms of the stock price, the share price. So remember, price is what you pay, right? That's not what the value is, right? What you're paying for, what the stock price isn't what the company's valued for. But if it is outside of your price range, you can always look at ETFs. And the great thing about ETFs when it comes to dividends is ETFs are holding a basket of stocks, right? And say an ETF is holding so let's look at XLK right now, right? XLK is a technology focused ETF that holds Apple, it holds Microsoft, it holds a Visa, it holds a MasterCard, and NVIDIA, right? All growth and tech-based companies, but they all pay a dividend, right? So at the end of the year or quarter or whatever, you really have to just look into the kind of the payment schedule of each ETF, but it'll tell you how much is paid out to the shareholder on a pro-rated basis, right? So say an ETF has $100,000 in dividends that is paid to them by the underlying stocks within their portfolio. They then take that $100,000, right, and they split it up amongst all their shareholders equally, right? So whoever's holding that stock is going to get a piece of that $100,000, right? So even if you're playing in the ETFs, you're still going to have access to dividends. Another way we can look for dividend-paying companies are through REITs, real estate investment trusts. Right? So these are companies that were built and designed through their tax structure to be identified as real estate investment trusts. And in order to be identified as one of these companies, the main criteria is you need to pay 90%, at least 90% of your cash flow to investors, to shareholders, right? So REITs are designed for dividends. Essentially, they're designed for income. And the best part about them is if you're someone who likes real estate, if you're someone who wants to get into real estate, but the price point is too high, you don't have 20, 30, 40, 50, $60,000 just laying around, but you got a couple hundred, right? And you can buy a growth company, you can buy a couple shares of like an AT&T, something that will pay you. I'm sorry, now AT&T is a dividend paying stock, but a REIT like an O Realty, there's a RQI, a Realty Quality Income, a STAG, right? Like an industrial REIT, right? So there's different REITs across different sectors that will pay you to hold their stock and that they're specifically managing and holding companies that they're collecting rent on, right? So you can be a passive landlord. And then this last one is closed-end funds. So closed-end funds are really, really cool in which you can really avoid the dilution of the shares by investing in these types of funds, right? So with closed-end funds, the idea is that the shares that are out there are the shares that are out there. So unlike a mutual fund or an ETF that, depending on demand, the fund managers will issue new shares to give to new investors, closed-end funds, once they're established, the shares that are traded can only be traded on the market, right? So you can only buy a share if someone else is selling, right? The fund manager isn't going to issue a new share and further dilute the portfolio, right? So with that being said, those will offer higher returns and better income streams most of the time, right? And a lot of times, what I found in my research is that these closed-end funds pay on a monthly basis, which we'll get into that as an income strategy later. But again, like when you're thinking about income, right? How often are we getting paid now? How often is our single skill set getting us paid right now, right? Some of us are getting paid every 2 weeks. Some of us are getting paid monthly. Some people are getting paid on our first 15th, right? If you have companies that are paying you monthly, quarterly, annually, right? Start thinking about, wow, there comes a point where these companies are now paying me more than my job will, right? So these are numbers that you got to really start to think about when it comes to dividends and what a company is actually rewarding you for having their company, right? So let's talk about the best of the best. So to further kind of narrow down your pool of who you should be investing for dividend sake, right? Right. So we have obviously these different kind of sections you can choose from, but within that, we have the companies that are the best of the best. So the people who have been paying, not only paying, but raising their dividends. So people who have been, again, bringing in enough money and care enough about their shareholders that not only are they going to pay you consistently, they're going to give you a raise every single quarter or every single year, every single month, right? So think about how often we get raises and promotions and all these things, right? And how often those raises and promotions don't feel as fulfilling and they kind of don't make a difference because, they happen every so, often, right? Imagine companies doing this 50 straight years, giving you a promotion, giving you a raise, right? So again, talking about buying back your time, why not let a dividend king who's been raising their dividend 50 straight years, or an aristocrat 25 straight years, or a champion who isn't an S&P 500 company, but they've still, raised their dividend 25 straight years, right? These are the types of companies that we want our money to be working in. So when we're talking about investing in the long term, right? I always talking about mitigating risk, right? The more educated you become and the more you mitigate your risk, the less it feels like gambling, right? Investing should not feel like, oh my God, I hope this works out, or I hope this company does this, I hope this does this, or man, Dogecoin is doing this, and like, man, I really want to be a part of, fear, hope, none of that is a strategy. And the best way we can mitigate that is trusting our research and trusting companies that have been around longer than a lot of us have been alive, right? Why not just put our money to work in companies like that, right? And that's just on the surface, right? And not diving into their leadership, their management, their direction aside. It just makes more sense, right? Trade your time for money, but then take that money and put it into companies that are working 24/7, right? So dividend dates to remember. So these are things to remember when you're investing in your AT&Ts, you're investing in your Apples, you're investing in your O Realties, you're investing in your Microsofts. Regardless of how big or small their dividend is, these are dates to remember, right? I didn't put the announcement date on here because the announcement date is kind of just like, okay, they announced it, right? After that, shareholders have to approve the dividend, and more often than not, they do, right? But these are the 3 dates you want to remember, and this comes into strategy, right? These aren't just dates just to have, right? These are dates that you need to know when building your portfolio. The ex-dividend date. So this is the date that determines eligibility for the dividend, right? This is the expiration date for if you don't have the stock by this date, right? You won't be eligible for the next dividend payment. So if you buy the stock on the X date or after, that's the cutoff date, right? So you have to buy the date before the X dividend date, before the cutoff date, right? So if the X dividend date's the 25th, you need to buy that stock or share. You need to be holding that by the 24th in order to be eligible for that dividend, right? The record date. The record date is the cutoff date established by the company in order to determine which shareholders are eligible to receive, right? So this is essentially the day after the expiration date, right? So expiration date expires on the 20th. So you have until the 24th to buy. The expiration date is the 25th. And then the 26th is, okay, these are the people who have it. These are the people who are on record. These are the people who are going to get paid by the payment date. So these dates, the question in the chat is how far out is that date typically, and or does it range for every company? It does range for every company. So typically these dates are, the X date is about a month to about 6 weeks before the payment date, right? And then they usually announce the dividends like whether it's going to be increased or paid the same, usually around earnings, right? So if a company is going to be paying quarterly, they'll usually talk about it at their earnings, establish the next execution date, and then the payment date, because they have to give the shareholders enough time to first approve it, and then everybody needs to buy their shares. And then it does range for each company, because there's companies that can pay special dividends, once per year, once per month. A company may be like Costco recently, they were doing so well, they paid all their employees like an extra $10 per share, at the end of the year, this past year. So it really depends on the company. And again, dividends are not like mandatory, right? A company doesn't have to pay a dividend. Just because a company was paying a dividend yesterday doesn't mean it has to pay today. Case in point, companies like Disney, companies, a lot of companies in the REIT sector actually, because they couldn't collect rents, were cutting their dividends because they were like, wow, we have to choose between, paying our shareholders or keeping our company afloat, right? So I think you'll see Disney bring back their dividend, obviously, eventually, because that's a big reason why people invest in Disney. But it goes to show you, even these big, powerful companies are not playing games, right? If it's between the dividend and the company will always choose to keep the cash in hand. So here are some other metrics to consider when looking at dividends specifically. When you're looking at an income building portfolio specifically, this is what we're talking about, right? We need to be paying attention to the payment schedule. How often am I getting paid, right? The same way you're in tune with how often you get paid in your current job, right? You need to be in tune with how often you're getting paid in your portfolio, right? I can tell you right now, TD Ameritrade has a great tool where whatever stocks, and I'm sure there's other in other accounts too, where you can see this type of information, but it tells you, it breaks you down by month, by quarter, by year, how much you're getting paid from your dividend holding stocks, right? So these are numbers you want to know, because that can be the difference between you retiring in 10 years or 5 years, right? These are the things we got to think about when we talk about making our own destiny and building out our own legacy, right? How often are we getting paid? Dividend yield percentage. So this is the ratio that the stock is paying out in relation to its stock price. So how much of its stock price am I getting back for holding the stock, right? Am I getting 3%? Am I getting 5%, 7%, 10%, right? Something we want to pay attention to when it comes to dividend yield is that just because the yield is high, right? Just because a company's paying 7, 8, 9%, that doesn't always mean that it's a great dividend paying company, right? Is that yield going up because the stock price is going down, right? Is that yield going up because there's kind of indecision between the management? Is there a lot of mismanagement of money? Like, why is that yield so high, right? Just because it's a high yield doesn't mean it's a great stock. Payout ratio. How much of that cash flow, how much of that free cash flow is the company paying out to us as an investor? Yeah, we want companies to pay us, but we don't want a company paying us all their money. We want the company to be reinvesting a majority of their money into growing the company, because ultimately the dividend doesn't really compare to the growth of the stock. We want companies that are going to be around for years, 5, 10, 15, 20 years from now, right? We want companies that when we pass them down to our grandkids, when we pass them down to our great grandkids, they're still paying them, right? So a good payout ratio to really think about when it comes to looking at a company that is in good control of their finances and is making sure that they're keeping shareholders happy, but also focusing on growth, is about 35 to 55%. Anything higher than 55%, you want to start putting a little bit of side eye on it, because it's like, yeah, you're paying me a lot of money, but like, does this mean that you don't really feel good about your growth prospects? Do you feel as though paying me is better than investing in the company, right? So those are things we want to think about when it comes to payout ratio, and also the yield, right? Are we not making sure our money is the company not making sure the money is working for them, right? Are they being bad managers of money? Are they being over leveraged, right? So those are definitely things, 2 metrics we want to look at when it comes to, again, these these sections of companies, especially those REITs where they're designed to give income, we really want to give a close look at them when it comes to that dividend yield and that payout ratio. And then finally, the annualized dividend, how much in total am I getting from the company, either over the 4 quarters or 12 months? Like I said, there's companies that were designed to pay you quarterly, monthly, and then there's obviously special dividends that happen over time. So let's dive into a little bit of capital gains tax, and then we'll dive into questions, and we'll look at a couple charts, and we'll look at some dividend paying companies to see what their growth prospects are, and see if it's their dividends are sustainable, if the ratios are good, and other stuff like that. So capital gains tax, what you need to know, right? The skinny is, these are things that you have to be aware of, not necessarily because of what's on the surface, right? You pay taxes or you get fined, blah, 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 blah. Pay taxes, don't pay taxes. It's the right thing to do, whatever. However you feel about them, you got to understand why taxes are in place and why hikes happen, right? So just stepping back from taxes as a whole right now, we have to understand that when we increase taxes, we don't usually increase taxes for the non-wealthy, right? We don't usually target the middle class or the lower income class when it comes to tax hikes. We usually target the wealthy. And why is that? It's not because we really, I don't want to, I hate to say this, but I don't really think it's because we care too much about the middle class or the lower income class. I think it's because there's less wealthy people. So when these politicians are like, well, hey, who's going to vote us out? Who is going to actually have the numbers to vote us out? It's not these wealthy people, it's the middle class people who look like you and me who have the power to vote these politicians out. That's why they don't want us to vote, right? So when we're looking at taxes from a macro level, right, we have to look at them as a tool. The government, businesses, everything uses taxes as a tool. It should not be looked at as a punishment. Too often we look at taxes as a punishment. We look at our checks and we're like, wow, taxes, 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 taxes. Taxes are part of investing. They're part of living. They're part of working. They're part of living in a capitalistic driven society. So instead of complaining, we have to learn to adapt and start to play along, right? So back to capital gains tax, long-term, short-term. This is why I talk about buying and holding assets, taking advantage of time when it comes to mitigating your risk, but also letting these businesses and these assets grow for you over time, right? Because when you set up, situations where you're looking for quick gains and you're looking for quick money and you're selling and buying and holding and buying and selling and you're all over the place with your investment strategy, this is when capital gains tax becomes a hindrance rather than a gain for you, right? So when we talk about long-term capital gains tax, the way it's set up now, it's better for you to hold on to things for at least a year and a day, so you don't get taxed as much when you sell the asset. Right now, capital gains tax is at 0%, 5%, 0%, 15%, or 20%, right? Those are what you get taxed. And Mike, you can hop in at any point if you want to add to it, but those are what you're going to be taxed if you sell after holding stock specifically a year and a day, right? Depending on different factors. If you hold that asset for less than a year and a day and it goes up, say you buy a stock at 220, it goes up to 600 the next day and you sell it, right? You're subject to short-term capital gains tax, which is basically taxed at ordinary income rate. So whatever your tax bracket is now, so whether it's that 10%, 12%, 22%, 34%, whatever it is, that's what you're going to be taxed. So that 600 is going to be taxed at as high as 37% if you're making buco, right? If you're making a lot of money, right? The idea here is that we ideally don't want to pay any taxes, but if we can mitigate when, where, and how much tax we're paying over time, we want to do that, right? So we want to ideally hold onto these assets for long term. That way they raise in price, raise in value, but we also don't have to pay as much. Like the IRS is rewarding us for being patient and being an investment mindset rather than a gambling mindset and a get rich quick mindset, right? So diving into that a little bit more, right? This new proposed tax hike, right? The one thing that we really need to think about is if you're not making, over $1 million, don't worry about this tax hike, right? It's white noise, right? When I'm talking stocks specifically, right? When you see stocks go red because things like this come out, ignore it, right? If you're not a millionaire, if you're not someone who is making a ton of money right now, ignore it, right? Use this fear as a lesson, right? So 3 things to consider. It's a significant increase for people who are making a lot of money, right? Not gonna lie. 20% to almost 40% is a huge hike, right? So if you're making a ton of money, I would be mad too, right? However, I would not be mad if I knew that 75% of investors own stock and other assets and accounts that aren't subject to a capital gains tax. So even if you are a millionaire and you're making a ton of money, there are ways you can maneuver your money so you still aren't subject to capital gains tax at all, right? So again, when it talks about human psychology and misdirection and where the government and where the wealthy want you to be looking, they want you to be thinking, they want you to be mad about these long-term capital gains tax because they're mad about it. But in actuality, we have things in place that can protect us and still allow us to grow our money like they do, right? Roth IRAs, retirement accounts. So not just Roth IRAs, but traditional IRAs too, 401ks. Those are your best moats really around your wealth. If you can save for retirement and also put yourself in a position to keep your income growing, you're in a great place, right? We know 76% of Americans are living paycheck to paycheck, right? We know out of 10 people who are making 100K a year are living paycheck to paycheck, right? We know 1 in 4 people think they're gonna die with debt, right? We know the average American worker, the average worker in general, cannot work enough hours to save for retirement, right? So no matter how hard you think you work for this job, you will never, ever, ever, ever make enough money to retire safely, peace of mind, enjoy your kids, your grandkids, right? So we have to do everything we can now to leverage the power of these great wealth vehicles that have been hidden from us, right? That have been told that you need a finance degree, that you need access to better education to know about these things, right? We need to be able to know that these things are set up for us to succeed, right? So other ways, we could talk about Roth IRAs a little bit later, but get yourself one, right? Anything that you contribute into them, you can take out, right? Without penalty. So if the max is 6,000, right? And you contribute 6,000, right? Anything that you put in, you can take out, right? Anything that grows in there, right, is also going to grow tax-free, right? So if you wait until the retirement, the distribution age of the Roth, right, anything that has grown over time is going to be tax-free. So you won't be subject to any of those capital gains tax, right? Protect yourself. So recommendations when it comes to dividends specifically, right? It's the same as everything, right? Educate yourself first, then take action, right? You want to make sure that you're doing enough due diligence where you can sleep at night and feel good about what you're doing, right? But you don't want to have information overload. You don't want to be frozen in inaction, right? You don't want to read everything and then freeze, right? You want to do things. You want to make sure that you're applying what you're learning. Understand your risk tolerance. I don't care who you pay, who you talk to about your money. They're not going to care about it more than you do, right? So understand your risk tolerance, understand your tax bracket, understand how investing is either going to make or break, right, your wealth building journey, right? Because only you are responsible for it. Your future generations are counting on you. Pick a strategy and stick to it. I already talked about FOMO not being a strategy. Fear is not a strategy. Hope is not a strategy. Investing is a journey, right? There's going to be bumps along the way, but humble yourself, right? You can learn something new every day. Take time to learn, take time to apply, take time to ask questions, and do it today. Start today. Start buying back your time. Start thinking of the places you work. And I know we all say we love who we work for and all this, but the fact of the matter is your time is not yours, right? And when your time is not yours, you can never really truly be at your best, right? So start buying back your time by investing your money in companies that will give you rewards for holding them, right? So any questions on that? Let me pull up peeps. And we can dive into any questions. And if there's no questions, we can pull up a stock chart.
Can you hear me?
Oh.
Can you hear me?
Elena.
Yeah. Can you hear me?
Oh, here we go. There we go. There we go.
Oh, wait. Can you hear me now?
I can hear you now. Good.
Oh, maybe I'm using my plush blanket was blocking the microphone. Maybe. I don't know. Okay. I'm going to ask this question after this amazing presentation that you just did and after having that long call with you the other night. But so it's kind of dumb potentially.
No dumb questions.
What is a stock what is a stock if you're not getting paid? Like, why would you invest in the stock market if you're not getting paid out a dividend? Or like, what's the opposite of a dividend?
So the dividend, think of the dividend as a reward, right? Like dividends are not, the majority of companies don't pay dividends, I would say. Like the stock market was built upon companies in growth, right? It's meant for companies to grow or not exponentially, but continue growing, right? Companies on their own decide how much value they want to return to shareholders.
Right? Why would I invest in a company that's not paying me?
Because you may not be interested in income investing, right? So like so there's companies that if you're looking at their yields, right? So let's actually pull up right here. Let's bring up Qualcomm, right? So Qualcomm is categorized as a growth company, right? So this is a company where their revenue, right, grows exponentially year over year, right? You're looking at those. So their revenue over the year, right? So you're looking at 22 billion to 24 billion, 23 billion, 26 billion, right? This is a company that is then now going to take that money, their operating expenses, right, and reinvest most of that into growing the company at an exponential rate. So they just want to grow the company for shareholders specifically, right? They'd rather reinvest the money into because they mostly do mobile phones and infrastructure, right? So they may want to take that money and buy, more land to put down more phone lines, right? They may want to take that money and buy up another competing company, right? So you're investing more so to grow your portfolio from like a small amount of money to a big amount of money in a short amount of time. Like the Walmarts are not going to, move $7 a day, right? 5% percentage points in a day on average. But a Qualcomm, a growth type company, is going to give you this type of movement in your portfolio. So if you're looking for a company that is a lot less volatile, right? So a company that is going to, like, you're going to look at it and be like, okay, it moved, 49 cents today, or a cent today, like these slow movers on a day-to-day basis. But they're paying a dividend of $2.20 a year, you know, that's the type of company. Or even AT&T. We talked about AT&T the other day, right? AT&T, we looked at AT&T's chart in comparison to, so AT&T's for dividend yield, right? $2.08 a year. Their dividend yield is about 7% a year, right? Let's look at Qualcomm before we pull up the chart. Qualcomm's is at, you're getting about 2% of yield, right? So right now that 2% isn't beating inflation, but it is beating your savings account. So you can invest in Qualcomm, make $7 a day potentially or more, whatever. You know, those percentage increases are exponential, but you'll also get 2% on the yield, right? And you'll see on their chart here, those big jumps, right? So this is just over a year that they went from, it looks like, this about $77, right? To now they're at about 136, and they got to up to, it looks like, about the 170 range, right? And like, let's look at an AT&T in that same range. AT&T gave you a whopping, probably like $3 in that year. Right. So it actually traded sideways. So you actually lost money on AT&T holding it, or you've made 26 cents. Right. Yeah. So that's the fundamental difference between like investing in a company that is committed to a dividend and committed to paying out into its shareholders rather than investing in growth. You're only going to get, you know, in terms of the share price movement, a little bit of movement. And that's why you're depending on that yield, right? And that's a good point in terms of the yield, right? If we look at the 5-year chart of AT&T, everybody can see this. What's the general trend of AT&T? You don't even need to be a technical expert. What's the general trend of this chart?
Down.
Down. It's going down, right? The general trend is going down, but they're paying you 7% of their stock price. What would you rather have? A company that's going up and paying a little bit of dividend, or a company that's trending down but paying you a lot of their stock price and dividend? And this is just AT&T compared to a Qualcomm, right? There's a place for an AT&T in your portfolio depending on your strategy. Do you want a high yield portfolio that is going to keep beating inflation, right? That is going to keep beating interest rates on your bank account, right? Or do you want a portfolio that's going to be paying you, but also moving, you know, a couple $100s a day, you know? And I'm not saying like these companies won't do that for you, but you'll have to accumulate a lot more shares over time for it to really make those big price jumps. And then the simplest way to answer your question is it's preference. You know, it really comes down to, where do you want your money? Do you want your money in a value type company, or do you want it in something that's going to be a little bit more volatile?
I have a question. Elena, are you good on that, or I don't want to move on?
I'm just looking at my other notes.
Okay. So back to the ETFs and the dividend payments, does it work that the shareholder of the ETF gets a percentage of the dividend depending on what companies are in it, or is it paid to the fund and then the fund decides what to do? Like, does it go through the fund to the shareholder, or does it go to the fund and then they maybe invest in other companies, or like, does that have to go to the shareholder? I don't know if that makes sense. I'm not probably wording it right.
Yeah, so it works exactly like that. So the fund holds the underlying stock, right?
Right.
So they are paid the dividends, and then they take those dividends and then they break it up on a prorated basis. So equal amounts to the shareholder on that. So like the companies themselves don't pay the shareholder, they pay the fund who then distributes out
but
the
it
funds.
has to go to the shareholders. They can't hold that.
Right. So that's a little bit more complicated because there are obviously funds that are meant for dividends. So like a TDV, which is a dividend fund, right? It takes the dividends, it pays it out. There's also ETFs like an ARC that has companies that may pay a dividend, but in comparison to all the other companies in their portfolio may not pay a dividend. So the dividend paid out may not be, they won't base like what the payout is off of that one stock. They'll then just base the dividends out on the net asset value. And we can get into this some other time, but like that's homework for today. Yeah. Look up the net asset value of an ETF. And that's how most ETFs pay out their dividends. So the dividend specific ETFs will collect the dividend and then pay it out to shareholders on a prorated basis. But then most funds that aren't dividend specific, but they want to return the dividends to the shareholders, they'll pay out based on the net asset value of the fund.
Okay, thank you.
Yeah. Any other questions? Let's look at some numbers real quick here on, let's do Apple because they just did their dividend increase to 22 cents per share. A lot of people don't realize that Apple does pay a dividend. But they're obviously an amazing growth company. But something I want to show you guys on this Yahoo Finance is that you can look at the statistics. So when I was talking about the dividend yield and like the payout ratios, an easy way to find that is on Yahoo Finance. So obviously you can see here, they pay 82 cents a year. I don't think this has been updated with their new payout, but it's only 0.61% of their stock. Right. So when we're talking about dividend yield, maybe Apple wouldn't be in an income investing specific portfolio. But if it's a blended portfolio of income investing and growth, Apple would be perfect, right? They don't give a lot of yield, but I still think 0.61% is better than every bank account out there, right? But they're not paying you a lot to hold the stock. You'll get, those $3 aftermarket movements. We can look at Apple's chart here. Come on, bar chart. Data. Yeah, all the data. So when it comes to Apple's chart, this is just another way of understanding that kind of that's just the mentality of a company when it comes to where it wants to be, right? Apple makes money hand over fist, right? But that hasn't stopped them from, usually you have to choose what you want to do, like with the money. And most companies do choose, right? We're either going to invest in growth or we're going to pay the dividend. Apple's been able to do both. So like just looking over the year, right? $71 to a 133, it's going to give you both that growth, and then over that year, it's paid you 82 cents per share. So again, it comes down to the strategy of what we want to look at. And since we're here, let's look at some of my kind of favorite ways to look at whether I would invest in a stock or put it on a watch list or make it something that I would be comfortable leaving my money in for 5, 10, 15 years, right? So my favorite indicators, right, is first thing I like to do is look at the stock at the big picture, right? I like to look at from its infancy if this stock has been doing its thing, and obviously Apple has been doing its thing, right? Then you look at a shorter time frame, 5 years. All right, over the last 5 years, what has it been doing? You know, not even looking at the financials. What has the stock been doing? It's been going up, right? Last 5 years, I don't even need to know what they've been doing. I just need to know that it's been working, right? 3 years, same picture, right? But now I'm starting to see a little bit more of a clearer picture of what I should be looking for now, right? 3 years is now leaning into the present. Like, what have they been doing in their last 3 years to be innovating into now? What have they released recently that I can look back 3 years from now? Okay, they were in their innovation phase, and now they're in the position where it's out there, it's working, right? I'm in a process. I've seen product work, right? If you can see that, right, you're on the right track. 1 year. Now we got another clear picture, right? And in this picture, do we know if the stock is moving across, down, sideways? It looks like we're here, right? Sideways. And ideally, when it comes to this type of picture, we love this, right? Sideways movement is not necessarily an indication of anything other than indecision, right? It just means that people are undecided on whether or not the stock is going to go up or down. The bears, the bulls, they're both working hard, right? When it comes to investing, again, we're looking at that 5-year time frame. We want a nice, healthy chart. But when we come down to these shorter time frames, now we can start thinking about support and resistance. So when we're talking about buying and selling a stock, obviously I'm always going to advise buying and holding. But if you want to just get a simple understanding of what's happening and when you should be buying and when you should be selling, again, do your own research. Let's talk about support and resistance, right? Price action goes through cycles, right? Price action likes to mimic previous history, right? And stocks will always return to points that they've either tested in the past or have found kind of like a stop point, right? They've fallen to a level where they have now been picked up by the bulls, and the bulls will pick them back up. So this is a nice way of looking for those supports and resistance. So we can see here in the last 9 months that Apple has kind of done its thing up and down, but there have been key points that it's kind of tested and either bounced up or gone below, right? So let's start from like an easy point. Like, what's a point of resistance that we can see?
Like a value, a number, or a...
Like where do we see the stock hit a point and then immediately go back down, or repeatedly hit some type of point and then retrace down? Like, where's the obvious points? Right here, right? Big test here and then came all the way down, and then here, right? Another test here, came back down. Here can be a resistance point. Here can be a resistance point, right? So it tested that 137, immediately retraced back down, right? It tried to come up again, hit that 120 mark, immediately came back down, right? So the initial resistance was this 137, but it came up and tested this 130-ish range and came back down. So now this 130th range is the most recent resistance, right? So it came up. Here is a resistance point, came back down, but the next time it came back up, it only came here. So this becomes its new resistance. And then it retraced. This comes back up, right? Comes back down. And now it's blown past this resistance and come back to this point, which was an early resistance from before. So it came back and retested a point that gave it resistance before. And again, it dropped back down. It tested and it failed. This time it tried to retrace back up. It broke through the resistance point, reestablished a new resistance point, came back down to the old resistance, hung there for a few days, and then immediately retraced back down to its old resistance, back up to recent resistance, right? So you can see from the patterns here that it'll always retest. And not to get too much into like patterns and anything like that, but visually it's just easy for you to see where a stock is going and where it's heading, right? So these resistance points, right, may be resistance now, but in the future, they may then become support. So when we talk about support, where can we see support? We can see support here. We can see support here, right? We can see support here. Anywhere it bounced off, right? We can see supports established. So we know that when a stock is falling, we don't have to be like, oh man, Antonio, when is this stock going to stop falling? Or when is it going to keep rising? It's, well, look for the support and resistance. We know the stock right now is at 133. Where's the next point we think it could fall? Probably to this 126 range, right? Because that resistance point that used to be resistance is now support. It's the next support level. If it breaks through this support level, when's the next support level going to be? Right here. That old resistance that about 6 months ago, this was all resistance before. And once it blew past the resistance, now we're going to use these points as support, right? So we now know 133 is a possibility. And tomorrow, if it goes down to 130, we don't have to guess like, damn, where's it going to go next? We know that 126 is a possibility. And we know that if it goes past 126, what's the next one? Like this 122 range. And if it blows past this 122 range, we know this 119, 120 range is in play, right? So these are all checkpoints that we can look at when it comes to entering a stock position, right? So if that's a little confusing, that's okay. I'll have another session on indicators and charts. But when it comes to dividends, we really want to take a really macro level look at it and look at the chart. Is it a healthy chart going forward? Can they sustain their dividend yield? Is it something that is always going to be growing? Because we don't want companies cutting their dividends or staying stagnant and not beating inflation.
Antonio, I was going to ask a question with regards to the chart that you were looking at. Mm-hmm. So as a buy and hold investor, would it be smart then, if you're looking at the chart, to like set a cap, say like, if the stock reaches 145, you would sell some, and then it's going to fall, you go back in and buy it at a lower rate?
Exactly. That's what institutions do, right? They buy a price up, and then when they get to a certain point, they take profits off, right? And that selling induces a fear that they capitalize on, right? So here, just look at it, right? Over 2 months, Apple ran up $71 to, it almost doubled, right? So it came a point where institutions were, because remember, institutions have quotas to make, right? They have people's IRAs, they have people's retirements, they have mutual funds, like all these things have quotas that they have to return to their investors. So they have to take profits when they can. So they took profits, it induced a lot of selling. And then over time, Apple became oversold, right? People sold it all the way down to a 112, right? So that was a perfect time for institutions or a retail investor. So say someone who got in here, and rode the wave all the way up, this would have been a great time for you to buy more, right? So it really, in terms of the mentality, you hit the nail right on the head. It's you can look at a chart and tell yourself like, hey, this is a resistance point for this stock. I've looked at this chart and I've seen that it's gotten to this point 2 other times and couldn't break through. Now, if it breaks through this time, I can see that as confirmation, like, okay, it's going to keep going up to the upside, right? But if I see that it touches it and it bounces down, it's like, okay, this is what I've been waiting for. Now, where do I look for support? Where do I look for my next entry point? And another thing with that is also you want to just be, I lost my train of thought there. But it'll come back to me. But yeah, you got it there. Someone else have a question?
I have one on taxes, but I don't want to change the topic. If bear with me as I ask this question because it might not make sense. But if you invest in a stock that, say, you get like $1,000, but you haven't held it for a year and a day, you take that out, you invest in another stock, which you then hold for much longer. Then you want to take the money out. Does your account still have data and have tracked the like initial investment that you made that you didn't hold for a year and a day, and you're taxed more heavily on like a percentage of it? Like, how does it work when you're reinvesting it into more things that you might be holding for longer or shorter, or I don't know if that makes sense.
So I'm going to definitely pass this one on to Mike if he's there. But the short answer is, as long as you're buying and selling within the account and you're not taking any profits out, it really doesn't matter. You just in terms of like the selling portion and reinvesting into another stock, the clock per se restarts for sure. But in terms of the taxes portion of it, and again, I'm turning this over to Mike, as long as you're just dealing within either a tax exempt account or not taking those profits out, if you're not buying one day and then selling the other day and then taking the profits, you don't really have to worry about it. But Mike, you can take it away.
Yeah. Do you mind repeating the question just one more time, just so I make sure I gather?
Yeah, I'm just curious. Like, if you invest a certain amount and it increases and you pull it out of that, you sell that stock, you didn't hold it for a year and a day, you didn't hold it for a long time, and then you put it into something long, and you're making more money off of it. I'm just curious, like, if you're keeping it in your account, how the taxes work if you didn't initially hold that one that you may have like made a lot of money on for a long amount of time. Yeah.
So when it comes to long-term capital gains and short-term, it doesn't matter if you take the money out of the account or you reinvest it. If you buy and sell, you're going to get taxed on the gains that you made, whether it's in the short term or the long term. So it doesn't, think about it in a sense. And I don't know if you've ever done anything with a business, but if you're a business and you make money, if you get taxed based on the money that you make, even if you keep the money in the business. So what a lot of people do is they will take certain amount of cash out of their investment account or out of their business to help cover some of the tax burden that you will incur during that current year. The other thing that a lot of people do, and something that I strongly suggest, especially if you have a good financial advisor or a tax accountant, is to figure out ways that you can mitigate your taxes from a short and long-term capital gains. One of the big things that a lot of new investors are starting to realize is if you set up your trading as a business, and I know that might sound complex or and whatnot, but if you figure out a way to set it up as a business, you can actually take money out of that you made and then contribute it into an IRA. And because you're putting it into a Roth IRA, it actually becomes tax deductible. And so you don't pay taxes on those gains. So a lot of people do that. And those are all things that I would definitely talk to your financial advisor or your tax accountant on. One thing I always strongly recommend, especially for people who are trying to invest, is make sure you have a really good tax advisor, because all these things, like a lot of people don't realize how much money they could be saving. And then you can, either keep that in the market, put it into other investments, instead of paying it to the government.
Thank you. That was really helpful.
Let's see. What if you have a money market account? What's the, are you talking about in terms of taxes? Or, gotcha.
So with a money market account, there's really no difference. Are you talking about like putting money into a money market account that you like from gains, or are you talking about the gains that you already had and they were in a money market account? Yeah, so it really doesn't matter what would happen, whether it's a money market account or just a regular account. The big thing is long-term and short-term capital gains apply kind of no matter what account you're using. In terms of, I'm not too familiar with the money market account versus a Roth, but I have never heard of people taking money out of an account they invest in, putting it into a money market account, and getting it tax deductible. And the reason behind that is money market accounts, I don't believe, have anything to do with, with a 401k or a Roth. With a 401k, it's pre-tax money that you're putting into it. With a Roth, it's taxable, or money that you're putting into it that's already been taxed. And that's why it's a loophole, is because it's a different type of account. But how your individual tax return is set up is, if you're the primary business owner and you take money out of that account and you put it into a Roth IRA, they actually give you a tax deduction, and I believe it's up to like $16,000. And that's why I've always stressed Roth IRAs. I'm not very familiar with money market accounts when it comes to tax loopholes.
Hi, I've just want to clarify the previous question. So to Lexi's question that you had just answered, just to clarify, like if you go to trade a stock like in that same day, so you're selling and immediately reinvesting the whole amount into another stock, you would still pay the capital gains tax.
Correct.
In that trade. Okay.
Yes, and that's why a lot, like I said earlier, what a lot of people do is, let's say you put $1,000 into an account and you start trading, and a lot of your trades were short term and you made $500, so your account's up to $1,500. What a lot of people will do is they'll take like $100 or $200 out of the account to help cover you on the taxes of that $500 that you made. And so you still obviously have $1,300, $1,400 in your account. But that's where, like I can't stress enough, working with a good tax advisor or financial advisors, where you'll really figure out, do I need to actually take money out? Like I trade every day. I trade stuff on a short term. I don't know the last time I held something long term. So like all of my stuff, I have to make sure that I have other ways of figuring out how I can reduce my tax liability when it comes to all these capital gains.
I was always confused about that. So thank you. Always.
Yeah, I mean, because, like that's where it gets very confusing, because when it comes to real estate, and I won't take long on this, but if you sell a property and then you reinvest it in another property, you don't pay taxes on the money that you made because it's a reinvestment. Whereas in the stock market, it's totally different. There is no reinvestment. And Antonio can hopefully sometime get into wash sales and all the other things that come with, you know, all the nuances of trading, but it's a very different way of how they really take money from you in regards to taxes instead of the real estate market.
And a quick point on that, and that's really why I really invest for the long term, and I stress long-term investing, is so you don't have to really deal with a lot of the stuff that happens when it comes to trading. And I stress finding a thesis and finding companies that you love and just hold them. And, you know, and at the end of the day, you're going to pay the taxes, right? Like the taxes are going to be there. It's just whether you want to pay them now or later. And obviously there's ways to mitigate them. But yeah, I think we'll get into wash sales and stuff, maybe like episode 4 or something like that. But I wanted to show you guys something really quickly before we hop off. But if you go into Yahoo Finance, the statistics, I don't know if I finished the stop before, but if you just scroll down to the dividends section, it'll tell you the payout ratio, the X date and the dividend date. So that payout ratio I was talking about, where you want it to be, you know, 35% to 55%, this is where you can find it. So this one is Apple's. Is my screen not being shared right now? Yeah. Sorry. Share the screen. All right, here we go. So on Yahoo Finance, we're in the statistics section, and we just scrolled all the way down to dividends, right? So that payout ratio, right, for Apple is around 21%. So 21% of their free cash flow is being returned to us as shareholders. And something they mentioned today that they're doing is $90 million of share buybacks. So they're going to be buying back their own stock because they feel like the stock is undervalued, right? So that's another way that they're going to return value to you as a shareholder. They're going to pay you, and they're also going to buy back their stock so this price can go up, right? So again, those are just ways you can look at dividend companies to really separate who's who and who's good at what. Cool. Any questions before we hop off? Cool. Guys, this was great. Thank you again for another cool episode. I'm going to be putting up another poll, or maybe the next one will probably be in the indexes. There's a lot of different indexes that will also tell you what direction you need to be going into in terms of the market. So be on the lookout for that. But yeah, hit me up offline if you have any questions. I'm here. Cool.
Thank you.
Thank you.
Thank you.
Of course, guys. Have a great night.